Hi, I'm Sam Sells, and welcome to my podcast, Clean Money. I like to say investing matters, and my show is to talk with everyday folks that are not only creating great success, but making an impact in society and improving the lives of others. That is my mission, and I want to share my stories and others with you. Welcome to Clean Money. Thank you for joining with us again today for another great episode of Clean Money, where we talk about making a difference in the world through our investments of time and resources. Our guest today is George Burgess, and you have myself and Jesse Sells on the call. And we're going to talk today a little bit about family offices. So George, no, I'm sorry, not family offices. We're going to talk today about institutional partners. We'll talk about family offices on another day, but I often get asked, like, what's an institutional partner? I did not know when we got started what an institutional partner was. We were doing commercial real estate deals. We learned about syndication. We learned about how to do it ourselves. And we are moving and grooving. And probably 2 years into doing this, really started learning some of these very unique and powerful ways to scale in commercial real estate, and started learning about how the big boys do business. Big boys and big gals, I guess. I don't know if that's the best way to say that, but hey, they're big folks.
I don't think you say that.
Probably not. All right. So, George, you worked in that world. You still work in that world. And can you explain to folks what an institutional partner is, who they are, what they do, maybe some examples for us?
Yeah, absolutely. And I don't think your description of the word big was actually too far away from how I'll answer this. I get asked a ton, what is an institutional deal? I always say I work with institutional real estate developers, and they say, well, what is an institutional project? And I'm like, really, it comes down to size. So big is a great example. Institutional capital is very similar to syndications and big investors, and it's essentially a large pool of capital coming from various places and taking down these projects which are large in value. Typically, how do you define that? Because some institutions will come in and they'll write the minimum ticket is really very rarely less than $5 million. But I would say on average, an equity ticket for an institutional group is more so $15 million and above. And again, it's a very vague answer, and I want to keep it quite vague for several reasons. It's not as square box as you think, because even though an institutional investor is typically a group that have hundreds of millions, if not billions of dollars plus of capital under management or capital that they're ready to allocate, their actual projects can be smaller. So what they can do is actually look at huge assets where it's a $200 million project, or they could say, well, there's 10 of these $5 million projects, where each equity ticket's maybe $2.5, $2 million each time. So when you group that together, you have this big portfolio. It could be, a big mobile home park community. And as an individual, the reason I say that is because as an individual asset, you might not say that rundown, mobile home park is an institutional quality deal. However, when you bundle that up as a portfolio and you've got, economies of scales there, it becomes very institutional. But typically, the institutional capital, the investment firms are typically managers. And what these institutional managers do is they manage the money for other institutions like pension funds and life companies and insurance companies and, you know, big, powerful organizations that have a lot of capital that need to disperse that capital and protect the wealth. And one thing I learned working in the IFAs was everything is about diversification. So the good thing for us guys is when you look at these institutional groups, nearly all of them have some sort of allocation to real estate. So long-winded answer there, but really, an institutional investment group is essentially an investment manager that's managing a lot of money on people's behalves and deploying that capital into strong and solid investment vehicles.
Yeah, that's a whale of an investor. I know when you start out in the And retail investment, trying to find investors, you start out doing like $20,000. And then these institutional guys are coming in with the equity ticket, the amount that you need to raise, right, for the project, property, whatever you're working on. It's at $50 million or $5 million. Well, why don't we just do that? Why don't we just find one of those, George?
Yeah, that was. I mean, it's funny, right?
It's
You guys
easier.
know my
Yeah.
background well.
Yeah,
Yeah, I
just
mean,
one
you
ticket,
guys know my
one check.
background, and that's how I got brought into it, right? When I was looking at like syndicators and they're raising all this capital through retail, it's like it's a lot of work, man, and it's really hard to find the retail capital in some cases. Now, obviously, there's so many pros and cons to both. But I'm with you guys. No, we have the same attitude. I think that's why we get on so well. We go big or go home. The bigger, the better. That's kind of our mindset. And you guys approved it. You did that. You were syndicating deals, and then within a couple of months, you had done like two large projects, and you worked with institutional capital, and you've seen that difference, right? And how you can just do a much bigger project with one capital partner, one relationship, and it's maybe it's sometimes easier or sometimes more difficult, but it
Both.
is there. The options there.
Yeah, I think it's both easier and more difficult because it is easier to get. You learn when you start doing investments that getting $20,000 from somebody is pulling teeth, and then getting $100,000, it's easier. Institutions, there's a road, which we'll talk about in a second, of becoming trusted with these people, but then you also got to work with the institution, which could be great, or it could be working with a bunch of people that are corporate, and it's hard to get anything done because that's just the way it goes. Uh, but real quick, so what's in it for these institutions to work with us? Sam, do you mind talking about our institutional partner, how it worked with their fund, how much money they made on top of theirs, just so the listeners kind of understand this better and why they would choose to work with us?
Yeah, absolutely. So these institutions, they do not want to operate the project, meaning they don't want to be involved in day-to-day operations. They want to operate as an asset manager, which is different than a property manager. Property manager manages the property, takes the phone calls, deals with the toilets that don't flush, the tenants running around doing dumb things, and so forth, right? The asset manager manages the asset for the investor. It looks at the asset, let's just say an apartment complex, as a business and operates it as a business, make sure the property manager is doing the things they're supposed to do, developing the sites that need to get developed, et cetera, et cetera. Now, these institutional partners, they don't work with you if George, you said within a few months. Really, it was within a few months of us starting to work together. We got an institutional partner. In fact, you placed one or with us at one point before that deal went way sideways, and then everything had to get changed. And then we had, the next deal after that, we did close with an institutional partner. But I mean, those were deals number 21 and 22 for us, and a mix of syndications, joint ventures that we've done with just a single investor partner of ours, or we did all on our own. And so your track record really, really matters. If somebody's going to come in and write you a $5 million check or $5 million ticket or a $20 million ticket, your track record matters. And so this institutional group, they came in and they went through every single property that we had. We had, I think at that time we had about 8 apartment complexes. We had 10 mobile home parks. We had ground up storage. We had done, lots of different things, and they came in and they went through every single deal. So we spent hours and hours on the phone. Those guys listened to every single podcast that I had done and would ask me questions. Hey, Sam, on this podcast, you said this. Explain that to me. I'm like, holy moly, you listened to my podcast. They went through our records. They knew about our history in the military. They did just an incredible amount of due diligence, far more due diligence than any private investor has ever done with us. And what's great is, during that 3-month turned into almost a 4-month process of them vetting us, we won their trust, and we worked hand in hand to close this big apartment deal complex. And it was a very challenging closing. What was also interesting is that we closed with a very large, awesome bank. We got great rates, and that bank got kind of squirrely at the end there too, and we had to pull out some trump cards and get the thing done, which we did. So during the process of them vetting us, we also proved ourselves to them by going through just heck to get the deal done. And they saw that we were there to make it happen. We took over the project, almost doubled NOI the first year, reduced crime at the property by 70 something percent. I mean, we just crushed it, all within that first year. And so they are happy to work with us. We talk to them weekly, sometimes almost daily, as we work through the challenges of commercial real estate. Now, that answers part of your question, Jesse. What does that mean for you if you're listening and you're an investor, or you're a young syndicator? What does that mean? Well, two things. If an institutional partner is willing to work with somebody, it's highly likely that that's an excellent place to park your money, because those institutional investors, they've got decades of experience, they've got billions of dollars, they've got, premierly trained, well-educated people. They've got lots of staff to go through everything and just be very, very rigorous in their approach.
Also, this one has a personal relationship with the CEO of the lender. I mean, they're not
Yeah.
gonna try somebody just to ruin a relationship. Yeah.
Yeah.
Listen,
Yeah.
I wanna chime in there as well and just say, like, from my point of view, Jesse, what's in it for the LPs investing into deals with you guys? It's the local expertise and the boots on the ground experience that you offer. And it means that they can be a huge institution even in Europe. They could be based in the UK, have billions of dollars under management, and they need to rely on people like yourselves that understand the market. And it's not just understanding it from a macro environment, it's understanding when these little nuances go wrong in the property that keeps an apartment vacant for 3 months because the boiler's been damaged, or there's no hot water, or the electricity is not working. You guys just know who to call. And if he's not available or she's not available, you've got 7 other options because you're in that market. You have that local expertise.
Yeah. And I will tell you that it's really nice working with an institutional partner, because when things go awry, and they do, they like to say, one of the things they told us many times is, hey, every deal is different. Every deal has problems, whether it's Class A or Class C, and every deal is a war. So you fight all these battles, you win all the ones you can, and they're on a 10-year hold, and it's excellent. Now, we learned something super interesting, and this gets back to the point you asked earlier, Jesse. So why would you just invest in a fund like a mutual fund or a REIT, and your money goes to the institutional partner, and then the institutional partner then invests with a sponsor like us? Because this is exactly what happens. You invest in a REIT, you invest in a mutual fund. Guess where that money's coming? It's coming right back around to a group like us. So in the deal, it's a 90-10 split. So 90% goes to the institutional partner and their mutual fund. But that sounds great. 10% goes to us. But they per bit, so 10% is the max that goes to their investors. Why? Because in the mutual fund, 10% return is fantastic. Now, 12% goes to the mutual fund because 2% goes to the fund managers. The other 10 goes to the mutual fund. That's where if you put your money into a REIT, you're going to be getting 6, 7, 8, maybe 10% max. And then what happens to the rest of the money? Well, for us as investors, so we put in $500K of our own cash. They put in $5 million of their own cash, or $4,500, or $4.5 million, sorry. And that combined is $5 million that we needed for this particular deal. Over the lifespan of the deal, our $500,000 turns into a little over $7.5 million over 10 years. So we get a 12x on our money. The institutional partners, they have a little portion of that 10% that goes to their institution. So they also get a 12x on their money. investors get an average rate of 10% return. So if you're investing in a REIT, you're investing in a mutual fund, this is where your money is going, and you are capped at 7, 8, 10%, maybe 11%. And you're thinking you're doing fantastic. Meanwhile, the institution and the operational partners like ourselves are hitting 10, 12, 15x on our capital. It's an amazing difference of how that all works. Now, the other thing though here is that we take on the risk. And so for this particular deal, we paid $16 million. I'm the guarantor on that loan. The investors are not, nor is the institutional partner. And so we take on the majority of the risk. The institutional partner, for them, they don't have to take on the risk. We take on the risk. They just take on the risk of bringing all their investors in, and they just need to get their investors a 10% return. So it puts an institution in a great position. This is another reason why they want to work with partners who are willing to take on the risk, and they vetted these folks are capable of taking on the risk. And so that's why they like working with people like us. Now that was a mouthful, long-winded answer, but hopefully if you're listening to that, you're like, wait a minute. If I invest with them, I get a 10% return and you guys get a 12x. Now, if you come in and invest in a syndication, you're probably going to average a 15, 16% annualized return, sometimes even maybe a 20% annualized return. So you're going to make roughly, 150% more or 200% more going direct into a syndication than you would going direct into an institution who then charges fees and then plugs that money into us anyway. So either way, your money's going to go to an operator who's going to do the deal. It's just like, at what point do you enter as an investor on the institutional side or on the direct side? Now, to your point earlier, George, institutions only work with very, very well vetted sponsors and operators. And so you can know, like, if you're an investor and you can come in and you can ask this one simple question. What is the easiest question to ask a syndicator to determine if they are worth their salt or not? And the first one is, have you ever had an institutional partner?
Yeah. I was actually wanting to echo on that before when you were talking about, from a retail investor's point of view, when they invest with a group that's worked with institutional capital, typically that means that they've done the due diligence for you. So, if it's good enough for an institutional group, it's likely a good, well-vetted deal. And just to touch on the family offices very briefly, there's a couple of family offices that also only ever rely on doing deals where the institutional LP is in place already, because they know that they've gone through all of the rings and they've passed everything. So if there's an institutional partner that's give the green light, that's kind of like your first, checkpoint saying, okay, this is something that we can really consider.
Yeah, that's great. Absolutely great. I just think, I know, Jesse, you and I both, we talked to so many investors out there. Like, I don't know how to vet these deals. I don't know how to vet the operators. And, that's just a simple question. Have you ever worked with an institutional partner? If not, you just know you have to do a lot more vetting.
Absolutely. Especially when everybody says track record, track record, track record. Well, 2-3 years ago, you could be the biggest idiot in the room and make a ton of money because the market was just amazing. So everybody's track record looked great then. So how do you know who's actually doing a good job and who's just a victim of the market when it was amazing? It's by looking who they've worked with previously, what they've actually done, and who trusts them. So if you're a new investor, that's one of the biggest pieces of advice I would give you is look at who they've actually worked with before. Look at the projects they've done, what caliber, what level, and look when they did it. Because the market does affect us. And everybody's going to have good things they've done. And then if everything's all roses and sunshine and you've never had a bad thing happen in your project, then I don't believe you. I don't trust you. Because every property is a war. You're going to have weird things happen. But it's how you get through it and how you find the ways to keep moving forward and get that 12x. Or you can put your money in a REIT, forget about it, and get your 10%.
Maybe.
Maybe.
Well, George and Jesse, it's been fantastic talking to you guys today. I hope the listeners have learned some more about what it means, what institutional partners are in the commercial real estate space, what they look like. And if you're curious, like who are institutional partners, you can look at big institutions like Goldman Sachs. They're an institutional partner. They fund a lot of deals. Blackstone, BlackRock. There are probably thousands of institutional partners out there, all looking to place their capital with great operators. And if you need help as an operator to source, institutional capital, you're there, you've done a lot of projects, you've had a lot of success, then reach out to us. In particular, reach out to George, and you can always take those calls. And if they do want to reach out to you, George, and learn how to, connect with the institutional partner, or they think they're ready, or they worked with one in the past and they'd like to work with one again, George, how do they find you?
Yeah, so anyone can find us on obviously LinkedIn, just under George Burgess on LinkedIn. That's a great place for me. And also my company website, which is burgess-group.co.uk. And of course, if any of the guys want to reach out to you guys as well, obviously we work very closely and we can still handle that in-house. And one thing I wanted to add to that, Sam, as well is, I get a lot of questions, and I know you guys have a lot of GPs that listen into the podcast as well. And one question I do get often is, where do you find these institutions? You kind of touched on it then with some of the big names, but like you also said, there's thousands of them. And this is something that I'm very excited about with what I do because it's simple and I like simplicity. It's not easy, but it is simple. And when it comes to accredited investors and you say, how do I find accredited investors? It's there's so many different options, but typically private investors don't just say, "Oh, my name's George. I've got all this money sat in the bank right now. I'm an investor." It could be anyone, right? It could have came from inheritance. It could have came from winning the lottery. It could have came from a business I've just sold. But no one really advertises that, so it's hard to find accredited investors. Whereas institutional capital investors is very easy. You can buy softwares. There's institutional databases that that store all of the access to every institutional real estate investment firm out there. And it shows you what they're investing in, what kind of equity allocations they're putting it into, the strategy behind their investments. So that's, been a really amazing insight for me over the years, just to see how easy it is to get in contact with these firms. And they want to be reached out to. They want people like us to come to them and say, "Hey, we got an opportunity that might fit your fund or your strategy. Let's have a chat. Let's show you the deal and let's get to know each other and let's show you all our deals." And although it's a big, scary institution, it's still humans that are behind that desk and that computer screen. So you're still having these human interactions with really great, friendly people, and they're out there. And we've been fortunate enough, over the short time I've been doing this of 4 or 5 years, to build up many great relationships with these firms, and it continues to build. So, they're out there, they want to see your deals. And, of course, we can absolutely be a helpful resource to anybody listening that, wants to grow those relationships even further.
Wonderful. Thank you, George. We'll have to talk again sometime about how these institutions deploy their capital, and the reasons kind of why they only do larger checks, because I know that's been confusing for folks. Like you said, it's simple. When you understand it, it's very simple. It's just not always easy. And yeah, we could talk a lot more about this world because it's so different for the average person out there, the average business person who just doesn't understand or doesn't know how all of this works together. And it's been a huge learning curve for us, and it's been amazing. Well, folks, that's going to wrap it up today for the pod. Tune in next time, and we'll keep talking about this, institutional partners, what they are, and then we're going to get into some family office stuff and explain that as well, which is a super interesting topic that I'm sure you guys will not want to miss. Thank you all for joining, and we'll talk Talk to you all next time. Thank you for tuning in to Clean Money, where we talk about sustainable investing that improves society. We are passionate about creating great investment returns to investors who want to use their money to make a positive social impact in the world. If you enjoyed the episode, we'd appreciate a 5-star review. And if you are interested in making your investing matter, please connect with us at wildmountaincapital.com, or you can find me, Samuel Sells, on LinkedIn, on Twitter at Sells_Samuel, on Instagram at Clean Money Sam, or on Facebook. And finally, make your investing matter.